one of the things we talked about when it's appropriate to refinance your mortgage, as Stacey had mentioned. You know, it is, of course, if your interest rate's higher, it's always worth calculating your penalty. You know, you can get a quote on your penalty. You can see if it's worthwhile, depending on your equity position, to either incorporate that refinance, have that penalty incorporated in, and look at the lower payments for you, and going a different payment schedule to pay it off faster. We look at that and analyze it for you to see if it's worthwhile. If your current interest rate is a variable rate, what we're talking about, even if you have a good variable rate, if you have less than 2 years on that variable rate term, you got to start thinking about 2 years, 3 years out, okay? Because we only have one way to go. We do not want to go lower interest rates. Because the consumer says, well, why not? Why would we want to lower interest rates? Because the lower we go in interest rates, the worse the world is doing. You know, the economy is not doing well with low interest rates. You need to have some sort of a bump and increase in interest rates, because that means basically employment and jobs are working. Because going back to the previous slide in 2007, that was when prime was at its highest at 6.25%, and that was just before the financial crash, and that was when everything was gangbusters. The entire world was doing very well. And so we need that to happen again to get people back. Because unemployment is really the key thing, and that's just my own personal opinion is. If you want to look at the way where interest rates or economies are, look at what the unemployment rate is. Because if people have jobs, they'll make their mortgage payments. If they don't have jobs, they're not making mortgage payments. Hence why Europe's been a disaster. But that's a side topic. We'll get into that. The other reason, of course, is we talked about consolidating high interest rate credit card debts, payments for you. The other thing is if you want to purchase an investment property, and there are ways if you have good equity that you can actually take secured lines of credit out to buy a rental property that can be a tax savings for you. You want to definitely talk to your chartered accountant about that to make sure that it's viable for you, but those options for you. The one big thing that we're doing a lot of right now is home renovations. A lot of people are staying put in their homes, so what they're doing is they're either refinancing, take equity out of their home, or they're doing a secured line of credit as a portion or a combination of either or, and basically they're improving the value of their home. So they say, we're going to stay put here now for the next 5 to 10 years, so what we're going to do is we're going to redo the kitchens, the bathrooms, the roofs, the windows. So those type of things are going to add value to your home, and it makes sense for you to refinance it, because you're going to increase what you're going to sell it for down the road if you redo it. And of course, investments. This last one, we don't do a lot of that. I think you have to, if you're borrowing money out of your home and you're going to be investing it in the stock market or in a mutual fund market, be very, very cautious. Make sure you're working with a CA and making sure that financial planners have a track record if they're convinced to do it. I've seen so many people get hurt on these tax-deductible mortgage plans that have backfired, and we all know how the stock market is up and down, and it's very inconsistent. So just be cautious on those tax-deductible mortgage plans. All right, very cautious on that. So a straight line of credit, you can get up to 75% of the value of your property. That's the maximum we can do it. The banks do 65. We do have some credit unions that will go to 75% of the value of your property. You can do the blend, as I just talked about, up to 80%, and you can do a straight equity takeout. And that means refinancing your home. That again is up to an 80% value of your home. So whatever your property is worth, it's up to 80%. And of course, you can do second mortgages as well, depending on qualifications behind that for you.